If you think you actually own the silver sitting in your online brokerage account, you are living in a dangerous financial fantasy. On May 28, 2024, the Securities and Exchange Commission implemented a massive structural change to the global market plumbing. They called it the T+1 settlement rule. The mainstream financial media told you it was a massive upgrade for retail investors, promising that your trades would settle twice as fast. They sold it to the public as a technological improvement designed to make markets highly efficient. But they lied to you entirely. T+1 was never about retail efficiency. It was strictly about risk management for the centralized clearinghouses and the massive Wall Street prime brokers. By compressing the settlement window from 2 days to 1 day, they altered market liquidity. This seemingly boring administrative rule change is actually a loaded weapon pointed directly at your portfolio. It gives your broker the ultimate legal justification to force liquidate your paper silver holdings right at the exact moment the metal experiences a historic price breakout. Imagine this scenario that is rapidly approaching us today. The physical silver deficit finally overwhelms the COMEX paper manipulation. The price of silver violently breaks out of its multi-year consolidation phase, rips past $50, then $60, and suddenly hits $82. The media is screaming that a massive short squeeze is underway. Retail investors are celebrating, thinking they are finally going to realize the generational wealth they were promised. But behind the scenes, the T+1 settlement rule is triggering an absolute systemic liquidity nightmare. To understand how this trap is going to spring, you have to understand the hidden architecture of the stock market. When you buy a share of a silver exchange-traded fund like SLV, you do not actually get legal title to that asset. The shares belong to a shadow entity called Cede Co. You are merely classified as a beneficial owner. You have economic exposure, but you have absolutely no property rights. Your broker holds those shares in street name on your behalf. All of this is processed through a central clearinghouse called the National Securities Clearing Corporation. The clearinghouse acts as the ultimate guarantor of every trade. To protect themselves from systemic collapse, they require brokers to post massive amounts of cash collateral known as margin. Under the old T+2 system, brokers had 48 hours to locate and post this cash collateral. They had time to breathe. They had time to borrow money or shuffle assets to meet the clearinghouse demands during periods of high volatility. But the T+1 rule cut that survival window entirely in half. Brokers now have a matter of hours to post billions of dollars in cash margin. So, what happens when silver goes parabolic and hits $82 an ounce? The volatility metrics inside the clearinghouse risk models will instantly explode. The algorithms will calculate that the risk of broker defaults has skyrocketed due to the massive, unprecedented price movements. The clearinghouse will immediately issue catastrophic margin calls to your specific retail brokerage. They will demand billions of dollars in fresh cash collateral before the market opens the next morning. Because of the T+1 rule, your broker has absolutely no time to secure funding. If the broker cannot post the cash, they will be declared in default and forced into bankruptcy. Wall Street will never allow that to happen, so the broker reaches for the emergency escape hatch, hidden deep inside the terms of service agreement that you signed without ever actually reading. Every single retail brokerage agreement contains a clause allowing the firm to liquidate customer positions without prior notice to protect the financial integrity of the firm. You agreed to this. You gave them the legal authorization to sell your assets if they face a severe liquidity crisis. Your broker will look at their balance sheet and realize they need to raise cash instantly to satisfy the clearinghouse. They will look at your highly profitable paper silver position sitting at $82, and they will simply press a button to force sell your shares into the market. You will wake up the next morning, grab your phone, and check your portfolio, expecting to see massive gains. Instead, you will find an email from your broker stating that your position was closed for risk management purposes during a period of extreme market volatility and systemic stress today. Your account will show a cash balance. You will have been forcibly cashed out at $82. You might think you still made a decent profit, but you have just become the ultimate victim of the paper trap. Because an hour after your position is liquidated, the real squeeze begins entirely. With the retail paper positions forcibly cleared out, the bullion banks and institutional short sellers will use that artificially generated liquidity to cover their disastrous naked short positions. Once they are safely out of the burning building, the physical price of silver will detach entirely. The metal will gap up from $82 to $120, then $150 in a matter of days. The industrial users and sovereign wealth funds will panic by every physical ounce remaining on the planet. You will be sitting in fiat cash, locked out. You will try to buy back into the market, but your broker will restrict trading on silver securities, citing ongoing volatility and clearinghouse capital requirements. You will be trapped in depreciating fiat currency, while the greatest wealth transfer in human history happens right without you. If you think this sounds like an impossible dystopian conspiracy theory, you have an incredibly short memory. We have already seen this exact playbook executed in the real world. You only need to look back at the nickel market crisis on the London Metal Exchange in early 2022. When the price of nickel went completely parabolic and threatened to bankrupt a massive Chinese holding company and several major clearing brokers, the exchange did not let the free market function. They halted trading entirely. They literally canceled billions of dollars of completed trades then. They retroactively altered the price and forced liquidations to save the institutional players from catastrophic losses. The retail investors and the hedge funds who correctly predicted the squeeze were completely robbed of their profits to protect the centralized financial architecture today. We saw the exact same mechanism deployed during the retail meme stock frenzy in 2021. When the clearinghouse margin requirements spiked overnight, retail brokerages simply turned off the buy button. They forced the market to crash to save themselves from a liquidity failure. The T+1 settlement rule was specifically implemented to ensure that this forced liquidation process happens automatically and ruthlessly the next time a systemic asset breaks out. And there is no asset more systemically dangerous to the banking cartel than physical silver right now. Silver is the Achilles heel of the global financial system. The bullion banks have spent decades selling hundreds of paper claims for every single ounce of physical metal sitting in their registered vaults. They have suppressed the price to subsidize the modern industrial and tech economy worldwide. But the physical reality is currently destroying the paper illusion. We are in the 5th consecutive year of a structural global supply deficit. The mining sector is exhausted. We are burning through hundreds of millions of ounces more than we produce every single year to build solar panels daily. We need this metal for electric vehicles, advanced robotics, and military guidance systems. The demand is absolutely inflexible. A defense contractor cannot replace silver with a digital token or paper futures contract. They need the physical atom, and the global stockpiles are disappearing fast. The Eastern powers, specifically China and India, understand this perfectly. They have been quietly draining the Western vaults for years. They are taking physical delivery of the metal and flying it across the world. They are permanently removing it from the fractional reserve banking system entirely. This relentless physical drain guarantees that the paper manipulation scheme will eventually suffer a catastrophic failure. When the registered inventories drop below the critical threshold required to maintain the illusion, the price of silver will go entirely vertical in a matter of hours. The banking cartel knows this event is mathematically inevitable. That is exactly why the SEC rushed to implement the T+1 settlement rule. They needed a built-in legal mechanism to unilaterally separate retail investors from their silver assets before the true price discovery happens. They want to ensure that when silver hits $82 on its way to $200, the retail public is forcefully cashed out in dying fiat currency. They want the generational wealth transfer to flow exclusively to the institutional elite and the sovereign physical accumulators. If you are holding shares of SLV or paper futures or unallocated bank accounts, you are literally sitting on a ticking time bomb. You are trusting the very institutions that are actively betting against you to honor your wealth during a period of unprecedented systemic financial collapse everywhere. You are an unsecured creditor holding a digital receipt in a system that changes the rules whenever it starts losing. You must fundamentally alter your strategy if you want to survive this ambush. You have to remove your capital from the digital slaughterhouse before the trapdoor finally opens. The only absolute defense against the T+1 seizure is physical possession. When you hold a tangible sovereign minted silver coin or a recognized bullion bar in your own hands, you completely eliminate all counterparty risk. Your wealth exists outside the jurisdiction of your online broker. A clearinghouse margin call cannot reach into your private home safe and confiscate your physical metal. The SEC cannot write a regulatory rule that alters the atomic weight of your silver. When you hold the physical asset, you are immune to the forced liquidation algorithms of Wall Street entirely. If the paper price flashes to $82 and your broker forcefully liquidates millions of retail accounts, your physical stack remains entirely untouched. In fact, the ensuing panic and the subsequent physical shortage will only drive the value of your tangible asset exponentially higher. You must liquidate your paper silver proxies immediately. Do not wait for the volatility to begin. Once the price starts breaking out, the exit doors will be incredibly crowded and the brokers will begin restricting transactions. Take the fiat currency hit now and convert it to real money instantly. Buy American Silver Eagles, Canadian Maples, or reputable 10-ounce bars. Yes, you will pay a premium over the manipulated paper spot price. You must stop viewing that premium as a penalty. It is not a penalty. It is the cost of buying an insurance policy against a corrupt financial system. When silver hits $150 because the physical market has completely decoupled from the fraudulent paper exchanges, you will not care that you paid a $3 premium today. You will only care that you actually possess the asset, while everyone else holds digital air easily. If you are allocating a level of capital that makes home storage completely impractical, you must use fully allocated and segregated private vaulting facilities. These facilities must operate entirely outside the commercial banking network. and you must hold direct, exclusive legal title to them always. If you do not have the specific serial numbers of your bars and the legal right to walk into the facility and take physical delivery, you are still trapped in the matrix. Do not trust unallocated accounts where the vault provider can legally rehypothecate your metal to satisfy other clients. We are entering a period of extreme macroeconomic turbulence. The United States government is borrowing $1 trillion every 100 days. The interest payments on the sovereign debt are mathematically unpayable without a massive, deliberate devaluation of the underlying fiat currency fast. The Federal Reserve will be forced to print trillions of new dollars to monetize this debt. As the monetary base expands, the purchasing power of your savings will evaporate. This is a deliberate stealth default. Silver and gold are the only assets that have survived every fiat collapse in history. The people running the financial system know that the fiat paradigm is ending. That is why they are constructing these elaborate regulatory traps like T+1. They are building a legal framework to confiscate retail wealth and protect institutional solvency during the coming transition entirely. You have a very short window to recognize the battlefield and move your troops to higher ground. Do not let the complexity of clearinghouse mechanics and settlement rules lull you into a false sense of security. The jargon is intentionally boring to prevent you from seeing the actual threat. They want you distracted by the illusion of faster trade settlements, so you do not realize they have given themselves the power to sell your assets without your consent. It is the ultimate financial Trojan horse. But now you possess the knowledge required to completely neutralize their strategy. Take action today. Sell the paper and buy the metal. Educate your family and your peers about the difference between beneficial ownership and actual physical property rights. The coming wealth transfer will be absolutely ruthless, separating the educated minority from the trusting retail majority. When the COMEX finally breaks and the forced liquidations sweep through the retail brokerage accounts, the cries of injustice will be deafening. The media will blame market volatility or unforeseen liquidity constraints, but you will know the truth. It was a planned, controlled demolition by banks. You will not be among the victims because you chose to step out of their casino. You chose to anchor your wealth in tangible reality. Stand firm in your physical position. Ignore the daily algorithmic price smashes designed to shake you out. They are desperate illusions from a dying empire. The fundamentals of supply and demand are absolute. The physical deficit is real. The industrial consumption is accelerating. The sovereign accumulation by Eastern powers is relentless. The paper price suppression scheme is mathematically doomed. The only question is where your wealth resides. Ensure that your wealth is sitting securely in your own hands when the music finally stops. The $82 seizure is a very real threat to paper holders, but it is completely powerless against the sovereign individual. Reclaim your financial independence today before it is too late.